Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Relations here at PassiveInvesting.com. And I'm so excited to be joined by our guest today, Chris Lento. Chris, welcome to the show.
I'm happy to be here, Whitney.
Excellent. Well, hey, Chris, before we dive into the details of your Ascend at Stone Mountain property, 144 units in Stone Mountain, Georgia, tell us a little bit about yourself, how you got into the multifamily space, and where you're at today.
EM Capital is a multifamily investment company out of Boston. I've been around for about 6 years. And prior to that, I was a mechanical engineer working in the aerospace industry for 18 years. But in parallel, I was consistently investing in local multifamily here in the Boston area. And then, about 8 to 10 years ago, I started kind of figuring out what my transition plan was. I could kind of see my career ahead of me and just wasn't excited about it. And I was really excited about all the real estate that I had going on the side. And was like, how do I make that what I do every day? I started scaling up, started doing some out-of-state personal investing. And then once I was convinced that the model worked for me, went full-time and started raising capital and going much bigger. It's been a great journey. I've learned a ton.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Awesome. Well, I can't wait to learn about all the learnings from your property that you purchased here today. So let's dive in. Ascend at Stone Mountain, 144 units in Stone Mountain, Georgia. Now, you closed on this property December 2022, correct?
Correct.
Awesome. Okay. Probably the slowest month in one of the most down years that we've had in commercial real estate. What was the purchase price of the property?
Was $17,500.
$17,500. Okay.
Yep.
And 144 units. Do you know right offhand how much that is per unit?
It's like $125 a door, $126 a door.
Okay. Awesome. So let's back up the timeline. When did you first learn about the property and how did you get it under contract?
We had purchased and exited another property from the same owner in the past. And it went well, like the purchase went well, and we sort of developed a relationship. This property, although it was sort of one of those partial off-market deals, so it didn't get broadly posted, but we did go through a broker on it. One of the brokers that we had done the deal with prior reached out and said, hey, this seller is looking to sell a very similar property to the one you've already bought. If you can be in this price range, I think we can make something work. That's how we initially found out about the property. And we weren't the only ones. I mean, he put that out to a number of other people.
How many people were competing in the deal?
I think in best and final, there was about 5, but we didn't get insight into kind of like how broad it went out. But we didn't see it anywhere. Like we didn't see it on any marketing. This was a big national broker. We didn't see it like spread around.
All right. You went through a broker. It was a quasi previous relationship. Wasn't terribly competitive. Between seeing the property, did you guys walk the property at all before putting it under contract? Because you're in Boston and the property's in Georgia.
Yes. We flew down, took a look at it prior to submitting best and final. So we put the offer in sight unseen. We have a good property manager relationship with someone in Georgia. So they had walked it and they actually knew the property. They had like someone in their team had managed it in the past. They had a good feel for market rents, condition, any issues that might come up.
And what kind of class of property is it?
It's like a C plus B property. So it was in tough shape and we needed to put a ton of CapEx into it. It'll be a B when we're done with it.
Okay. C plus in a B area or CC plus in a B area. Okay.
Exactly. Yep.
All right. You get this under contract. Tell us how you structured the contract.
We structured the contract with an early access clause. As we're negotiating the purchase and sales agreement, we get access to the property. We go down, we bring our property management team, and we do like an extremely thorough due diligence. Walk every unit, head of maintenance come in, get a drone, look at all the roofs. We probably had between us, there's 4 of us, and then another 8 or 9 people from the property management team, like crawling all over the property. The reason we did that was because it allows us to then commit to like a 60-day close and go semi-hard on signing the PSA. So we're taking a little bit of risk when we deploy resources to go down there and do this pre-PSA due diligence. But at the same time, we can go hard, which makes our offer more attractive.
So how much money did you put down hard on this deal?
I think on this deal, we put $200K hard contingent on environmentals and title.
Okay.
So it had to have a clear title and it had to pass the lender's environmental screening once that came up. We were pretty confident in like the structural integrity of the property, all the work we had to do, our CapEx plan, right when we signed the P&S. And then, the lender came in and did all their due diligence and we supported that as well. But at that point, we were just off to the races, raising capital.
Before we get to the capital raising place, I want to kind of hang around on the due diligence piece a little bit more. Were you able to walk every single unit?
We were. Well, the team was. So we kind of broke up into groups of 4. Yeah, the property management team we use, which is First Communities, has a big presence in the Southeast. They have it down. This is the 4th deal we did with them. And I mean, they came in and, 2 people went over and met with the leasing agent and they started doing lease audits. And they basically spent like 8 hours just going through and making sure, like doing a lease report. And then kind of the maintenance team, there was 6 of them. They had a little meeting. They all had an app that they were going to take like pictures of these 6 things in every unit, like take a picture of the door, take a picture of under the sink, like all this stuff, the heating system. And they just divided and conquered and took pictures of every unit. And that all got aggregated into a like full report prior to. And it was done like almost right away. So it was pretty cool. And then they had another team looking at like exterior stuff, like roofs, drainage, parking lots, amenities. We walked every unit as a group.
Fantastic. Did anything come up on due diligence that was a surprise?
I think on that property, I think there was more windows that needed to be replaced than we expected. We hadn't originally budgeted in for so many window replacements. There's a lot of foggy windows. That's not crazy. And drainage. I feel like drainage on these like 80s properties is always a bigger issue than people think. So nothing like show-stopping. And then just the sheer amount of trees that need to be cut down and landscaping that truly needed to be kind of pruned back. It was like it was built in 1985 and they like didn't cut a shrub since then. Some of the first floor windows were almost completely covered.
Oh my goodness. I've owned property in very humid parts of the Midwest, not so much in the Southeast, but yes, the trees, you're just like, I just spent $10,000 trimming back trees last year and now you got to do it again. Did that, like with all the windows, 144 units, that can be quite a costly expense and then correcting drainage. Was that accounted for on your construction budget? Did you eat too far into your contingency line item or did you need a retrade?
We didn't need a retrade. And yeah, last December this is 22. So the market was still hot. It hadn't like got slammed by these massive interest rates. They were on the horizon. It was not a retrade environment yet. So that didn't even really cross our mind. I mean, if it had to, we would have. But no, we had enough contingency in our estimates that we were able to absorb absorb both of those things, like within the current capital raise plan. And we found that out, early enough that we could have raised more capital, which would have impacted our investor returns, but it wouldn't have been significant. We were able to absorb it within our assumptions.
Anything pop up on the lease audit?
Well, yeah, we did have one thing which came up during due diligence that wasn't expected, is that someone had recently fallen down the stairs due to like the stairs, they're like exterior metal stairways, and they had like rotted out. There was a pending lawsuit. That was probably the trickiest thing on this deal. Now that it's all coming back.
Metal stairs rotting out. Well, I guess it is the Southeast, like humidity and corrosion. Okay.
Right. So we had this pending lawsuit that we had to deal with that was on the prior owner, but the person was still occupying the property.
How did that work? Like from a closing perspective, getting insurance or
Right.
your
So
transaction, how did this all work?
the lender required us to, within 30 days, repair or replace all damaged stairs. And then we had to have a contract in place for that. And the insurance company wanted to see that contract. Additionally, there was a wrinkle that in Georgia, I'm not sure how long this has been going on, but that getting like full liability coverage is difficult in Georgia because the way that their like lawsuit rules work out is that you can go after owners for very high amounts. If you get beat up on a property or you get injured, you can go after the owners for like $2 million, whereas a lot of other states that cap that at like a lower number. So insurance was tricky on this deal. There were some players moving out of the market at the time. So between the stairs and like the personal injury, insurance was challenging.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFI Incon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFINPodcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
So did you have to take out an additional policy for yourself personally as the owner of the property? Or
I already have business liability insurance for the business, so I didn't, but that makes sense to have that.
You got all these small things that are cropping up. It doesn't sound like it's triggering a retrade. You're moving forward with the transaction. Tell me about the financing. Like this is December 2022. What kind of financing did you get on the property? Were there any prepayment penalties, lockout periods? How did that all go down?
Yeah, so we decided to actually kind of interesting financing on this one. We did a bridge loan with an in-the-money cap rate. We did a $17.5 million property, and we were putting $2.5 million in CapEx into it. We did roughly an 80% loan to cost bridge loan at like SOFR plus 4% or whatever the floating rate was, but then we capped SOFR at 2.5%. We kind of had to come up with this big interest rate cap up front, but we knew that since we were already in the money, meaning that we were paying for an interest rate that was below what the current market rate was, we knew that our debt was effectively fixed for a 3-year period. We didn't really care if interest rates went up. I mean, we would love it if they went down by like 2 points, but that wasn't going to happen, right? We effectively fixed our debt for 3 years. And that worked out very well. And we're getting these huge checks from the interest rate cap every month, which was part of the plan. They're bigger than we expected, but it kind of offsets with the loan.
Yeah. And I mean, can you do this type of deal today, get this type of lending today?
Actually, you could get this deal today. I think just recently, the debt markets have loosened up a little bit, and the cap rate will probably be less expensive because at the time interest rates were projected to go up, although not as much as they have. Whereas now there's a thought that, the short-term rates are going to come down at some point. You could probably, I'd have to re-underwrite it and see if it would still work today with whatever the cap rate would be. But conceptually, yeah, you could still do it today at the right price.
All right. So you're about a year into this business plan. At the 3-year mark, what are you looking for? Are you looking to do like a cash out refinance? Are you concerned about where the interest rates are going to be, or are you just going to flip it and sell it?
We had kind of a duel for this property. So we're at the 3-year mark, or really at the 2 to 3 year mark. We were going to look at the market and say, all right, do we want to start prepping for sale? Do we want to refi and make this like a 5 to 7 year hold? And with the market where it is right now, like a sale in the 3-year period, I don't think is going to yield the best returns for our investors. Now we're really prepping for a refi sometime in the next 2 years. And it really just the way that our loan is structured, we'll probably try to do that kind of sooner. The one kind of wrinkle on this loan is that we need to draw the full CapEx amount at 18 months, like regardless. So they just basically like cash out all that CapEx, put it in an escrow account, and we start paying interest on it. Now we've done probably 80% of the CapEx, and we have $400K in contingency that we haven't touched, and another $300K in planned renovations that we haven't used yet. And all of that is going to start accruing interest in the next 3 months. We're like inclined to refi sooner than later on that. So now it's just getting the NOI up to a point where debt service coverage on the new loan makes sense. So while we're concerned with the interest rates, we think we have the NOI to support a refi within that period.
Now, things drastically changed in the past year in a lot of markets. Do you see that being a challenge in this particular market, getting the NOI up? Like, have your projections changed with your rent growth or anything like that would impact your ability to get the refi done? And I'm asking this because I want to fully understand, like, what are the risks to you right now across the 3-year business plan and how you're navigating those?
I would say that the market is softer than we kind of originally projected, although our market rents are holding up. But what we didn't anticipate was the amount of bad debt and the extremely slow eviction process in this county in Georgia. It's backed up enormously.
Is that from COVID or just?
It's a COVID backlog. It's crazy how long it's been taking to clear out. We're at 7 months to get for an eviction. Which
I think some people in California would be thankful for 7 months.
I agree. And I live in Massachusetts, whereas 6 months is sort of almost what you expect. Yeah. But for Georgia, that's crazy. I mean, it should be 2 months max. We did not expect the amount of bad debt that we're seeing right now, mainly due to this court clog up process. So that's, we're spending a lot of energy hiring, there's a set out company that can cut, trying to understand the whole process, which typically as asset managers, I kind of leave that to the property manager. I mean, we ask them questions like, how's the eviction process going? Is there anything you can do to speed it up? But we're not in the day to day. And on this property, we're okay, lay out all the steps. Who does what? Okay, this is taking 2 months. Can that come down?
Yeah.
Where is the bottleneck?
Yeah.
Yeah, exactly. So that's been, I suppose, interesting or unexpected. And then I think marketing in the last year during COVID, you just had to put out a for rent sign practically, and 5 people applied. Rents were going up and there was this huge demand. And now you have to get back to, how do you market your property correctly? What are all the ways to do that? And I think a lot of the property management companies, we do third-party property management, are really waking up, or have been over the last year, waking up to this, things are not as easy to market anymore. We need to think more about this. And then in parallel, there's been so many new developments in marketing with third-party operators and different tech solutions that may or may not help. So I think that marketing has been kind of a big learning curve in the last year for a lot of people.
Interesting. Talk about the raising capital piece, just around 17 million, 17.5. Is that what it was?
75, yep.
How much of that, your 80% loan to cost, how much did you raise on this deal?
We raised about $8 million for this deal. And that was with 3 different groups. I have 2 different partners on this deal. And so we kind of effectively split the capital raising.
All 3 of you are general partners on the deal?
Correct.
And how did you structure this deal for your limited partners?
This was a 7 pref with projected 18% annualized rate of return. If the GP percentage is 25%, the LP percentage is 75% of cash flow above the pref and at the exit for profit. And then if the investor's LP position return is above 25%, that GP LP split on the exit switches to 60/40.
Essentially, there's an rate of return hurdle there.
Yeah, we use an annualized rate of return hurdle just because the math's easier, but effectively the same thing.
Okay.
I find it easier to explain.
Right? Yeah. If people ask me, like, what is an internal rate of return? I'm like, do you know calculus? Like,
yeah, exactly. Yeah,
I show them the math equation. They're like, oh.
Right.
Yeah. No, I would agree. And what type of fees did you charge to this deal?
We did a 3% acquisition fee. We do a 1% asset management fee of gross collections, and we do a 2% capital transaction fee at the exit or refi.
Got it. Just to wrap up a little bit, like, what did you think was going to be easy on this project that actually ended up being a little bit more difficult? And then conversely, what did you think was going to be more difficult that actually ended up being a little simpler?
Well, let me start with the second part of that question. This was a pretty heavy lift for CapEx. So we had to do a majority of the 22 building roofs. We prepared an enormous amount of siding, painted the whole property. We're doing interior renovations, parking lots. It had this extremely old, like, tennis court, sport court thing that we tore out and put outside exercise equipment and a pickleball court on, renovated the clubhouse. It was a relatively heavy value add, and that went relatively smoothly. We were able to find like a big contractor in the area that did a number of those things just all in. They broke it up, but we dealt with the same contractor on a lot of the big chunks, and they pretty much were on budget, if not always on schedule. For the volume of CapEx work, I think that went relatively smoothly. Getting the lender reimbursements is always a challenge in a timely manner. Getting that, like, lining up that cash flow where someone needs a $300,000 check and the lender's, I don't know, doing whatever they're doing, holding onto your money for first 8 weeks.
Or interest.
Yeah, right. That's been a little challenging. But yeah, I would say like the dealing with just the delay in the evictions was the most challenging, and working with the property management company to like find solutions to those problems.
Well, Chris, thank you so much for being on the show today and sharing your knowledge and expertise with us. If people want to find out more about you, how can they do so?
You can email me at chrislento@emcapitalgroup.com, or go to the website, which is emcapitalgroup.com, or you can find me on LinkedIn under Chris Lento.
Awesome. Well, Chris, again, thank you so much for your time today, and we look forward to hearing about future deals.
Thanks. I really appreciate it. Have a great day.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit PassiveInvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's PassiveInvesting.com. Thanks again for listening, and we'll see you on the next episode.